all of O-Levels Business Studies Section 5 definitions in 4 minutes. Startup capital is the finance needed by a new business to pay for essential non-current fixed and current assets before it can begin trading. Working capital is the finance needed by a business to pay its day-to-day costs. Capital expenditure is money spent on non-current fixed assets which will last for more than 1 year. Revenue expenditure is money spent on day-to-day expenses which do not involve the purchase of a long-term asset, for example, wages or rent. Internal finance is obtained from within the business itself. External finance is obtained from sources outside of and separate from the business. Microfinance is providing financial services, including small loans, to poor people not served by traditional banks. Crowdfunding is funding a project or venture by raising money from a large number of people who each contribute a relatively small amount, typically via the internet. The cash flow of a business is the cash inflows and outflows over a period of time. Cash inflows are the sums of money received by a business during a period of time. Cash outflows are the sums of money paid out by a business during a period of time. A cash flow cycle shows the stages between paying out cash for labor, materials, and so on, and receiving cash from the sale of goods. Profit is the surplus after total costs have been subtracted from revenue. A cash flow forecast is an estimate of future cash inflows and outflows of a business, usually on a month-by-month basis. This then shows the expected cash balance at the end of each month. Net cash flow is the difference, each month, between inflows and outflows. Closing cash or bank balance is the amount of cash held by the business at the end of each month. This becomes next month's opening cash balance. Opening cash or bank balance is the amount of cash held by the business at the start of the month. Working capital is the capital available to a business in the short term to pay for day-to-day expenses. Accounts are the financial records of a firm's transactions. Accountants are the professionally qualified people who have responsibility for keeping accurate accounts and for producing the final accounts. Final accounts are produced at the end of the financial year and give details of the profit or loss made over the year and the worth of the business. An income statement is a financial statement that records the income of a business and all costs incurred to earn that income over a period of time. It is also known as a profit and loss account. The revenue is the income to a business during a period of time from the sale of goods and services. The cost of sales is the cost of producing or buying the goods actually sold by the business during a time period. A gross profit is made when revenue is greater than the cost of sales. A trading account shows how the gross profit of a business is calculated. Net profit is the profit made by a business after all costs have been deducted from revenue. It is calculated by subtracting overhead costs from gross profits. Depreciation is the fall in the value of a fixed asset over time. Retained profit is the net profit reinvested back into a company after deducting tax and payments to owners, such as dividends. The statement of financial position shows the value of a business's assets and liabilities at a particular time. Assets are those items of value which are owned by the business. They may be non-current, fixed assets, or short-term current assets. Liabilities are debts owed by the business. They may be non-current, long-term liabilities, or short-term current liabilities. Non-current assets are items owned by the business for more than 1 year. Current assets are owned by the business and used within 1 year. Non-current liabilities are long-term debts owed by the business, repaid over more than 1 year. Current liabilities are short-term debts owed by the business, repaid in less than 1 year. Capital employed is shareholders' equity plus non-current liabilities and is the total long-term and permanent capital invested in a business. Liquidity is the ability of a business to pay back its short-term debts. Profitability is the measurement of the profit made relative to either the value of sales achieved or the capital invested in the business. Illiquid means that assets are not readily convertible into cash. Thanks for watching.